Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Dan Hill, who's the CEO and founder of Hill Wealth Strategies, and we'll be talking about tax-free retirement solutions. Dan, welcome back to the program.
Thanks for having me back again, my friend.
Hey, so tax-free, we love that. Retirement solutions, give me the solution to my problem. So this is a great sounding topic that I'm excited to learn about. You always have some very precise and unique perspectives that are eye-opening that, initially would make people go, yeah, that makes total sense. Never thought about it that way. So I'm excited to hear from you. So let's talk a little bit about some tax-free retirement solutions. Where do you start with the client when you're talking to them about making sure that the plans that you are putting into place for them are considering their taxes?
So yeah, always considering taxes. So one of the things I always talk to people about is we are tax planners versus tax preparers. Tax preparers, we ask people to bring two years of tax returns in, just so we can see if something happened. Oh, you sold a house this year, or you inherited some money, or something was different from year to year. So we always want to look at 2 years of tax returns. And a lot of times with our forensic analysis on those tax returns, we can see opportunities that the tax preparer, one, isn't trained for, or just not their job, right? You just bring in your shoebox and they prepare your taxes. We look at, there's opportunity for this, that, or the other. Okay. So we're always looking at what we call practicing tax avoidance, which is perfectly legal and may save you $20 versus tax evasion, which may get you 20 years.
Yeah.
So we're always as part of our comprehensive planning, looking at taxes. It's one of my favorite subjects. Like you hear me saying over and over, Mike, I want you to get every penny of your hard-earned money you deserve. And if we can save you a couple bucks on taxes, that's what I love to do. So I've kind of had a shift. You were talking about my perspective. I have this little rule of thumb for me of like, put as much money away now because you're typically in a higher tax bracket when you're working. And so let's just say you're in the 22% bracket. That's where a lot of people fall when both spouses are working. So that means every dollar you put into your 401k before taxes, you're saving 22% in taxes. So it's like the Internal Revenue Service giving you a 22% match. So if you put away $10,000, you save $2,200 in taxes. But as tax rates have come down here recently, actually 2017, I kind of changed my perspective and look at, okay, so these are some pretty attractive tax rates that we have, starting at 10%, 12%, and then jumping up to 22 and 24. They're some of the lowest that we've had in history. So we've kind of changed our perspective on, let's not max out our before tax contributions. Let's just put in to our 401k whatever they're going to match us, okay? And then look at doing some tax-free, some Roth contributions now, whether in the 401k or in an individual Roth account, if you're eligible to do that. It's income driven, so not everybody can do that. But so that's how we're kind of shifting our perspective here with the current tax laws, which should be in effect for a couple more years, about let's take advantage of these opportunities now to go ahead and pay taxes today versus maybe 10 years from now, or when we turn 73 and we have to take money out of our IRA or require minimum distributions, where who knows what the tax rate might be then.
Yeah, that's a really good point that you bring up there, because why contribute more than what I match is, whether it's from the government or your employer, and make sure that you're maximizing every dollar to get every benefit out of it. And like you said about taxes, if there's a tax strategy or a break that you can take advantage of and it's all legal and above board, I mean, guess what? I've heard tell that the IRS tax code is many pages, in the thousands and thousands of pages. So how in the world is anyone supposed to understand that? So if you can latch on to some opportunities that way to really increase that cash flow a little bit, that allows you to put some more money into some good, safe planning for retirement. So that really is a huge piece. You mentioned Roth. and Roth contributions. So there's different, restrictions and limits and all of that. Talk a little bit about something I've heard of, which is a Roth conversion versus a Roth contribution.
Yeah, very, very good question. So conversions are a lot different actually, because as you said, there's an income threshold. It's somewhere around 200,000. The numbers change every year, so I don't know what the 2025 numbers are. So if you're adjusted gross income, a married couple is over like 200. You can't do a Roth, but you can do a conversion. Okay, so we're always looking at those opportunities. I tell this story all the time about Lisa. So Lisa's a retirement candidate of ours. She came in at 65 years of age, like a normal retirement for many people in the baby boom generation. She has no debt. She's got $2,500 a month in Social Security. It's $30,000 a year. It covers her living expenses. Okay, and living expenses are everything that's not debt. So she has no house payment. Excuse me, no car payment, no motorbike, no boat. And she spends for gas and groceries and cell phones and gifts and whatever. $2,500 covers that. And she also has a $300,000 IRA.
Okay.
So I always pose to classes when we're teaching our tax classes, what is Lisa's federal tax liability? All she has is $30,000 worth of Social Security. And people, like I said, because they don't speak the language or it's not their area of expertise, it's zero. Because if all you have is Social Security income, you count half of that towards your income, and you don't have to claim it if it's below $25,000 if you're single, like Lisa is. So Lisa has no federal tax liability. But what she does have is an opportunity and a coupon. She's not using her standard deduction, which is somewhere around $14,000. So what we're doing with Lisa, to cut this story short a little bit, is we're taking, and she's 65, right? So she doesn't have to take required minimum distributions on her $300,000 IRA for 7 years, 8 years. So if we got a good asset allocation portfolio going on, it's going to be a lot more than $300,000 in 8 years. So the required minimum distribution is going to be larger, and the tax is going to probably be greater. So now we have an opportunity, since she's not using her standard deduction, to take about $10,000 a year over the next 8 years out of her IRA tax free. And then we're putting that in a Roth. So we're taking her IRA, converting to a Roth, and in her case, we're keeping her in a tax-free bracket. That's her pain point, I like to say.
Yeah.
Bill, another client of ours, has a $2 million IRA. He's okay paying up to 24%. So the bracket goes 10, 12, 22, 24. Phil says, hey, I'm going to go ahead and pay 24% today because I think it's going to be a lot more by the time I turn 73. So we get on our little calculator and we calculate, okay, Phil, you can move X amount of dollars, and here's the tax ramifications. And that's his pain point. So I always tell people, we're going to do the math for you, and you can tell us, how much you want to do.
If it hurts enough, too much or not enough. Yeah.
Exactly.
Well, with that conversion strategy, as we've said before, there's never one size fits all. Is not the best decision for every single person. So definitely check the numbers. But with that strategy, you need to make sure that there's enough runway ahead of retirement that then the Roth can grow tax-free. Right? Because if you convert it now and pay taxes now, okay, that's a hit. But then you put the money into a Roth. Well, you need a minute or two or X number of years for it to grow, to kind of recoup that, and then to have that tax-free growth.
Yeah, it's definitely a critical part of the math. I had some lady come in. She goes, "I want to convert my whole IRA to a Roth." I said, "Okay," and I went, "Okay, that's going to cost you $20,000 in taxes."
Yeah.
She said, "Oh, I don't want to do that." Yeah. I didn't think you did.
Yeah.
Okay.
Yep.
So
because they heard something on Google or they heard their friend do something and they go, "Oh, that sounds good, but let's see how it applies to you. Let's run the numbers."
Yeah. So if 20,000, like you said, okay, 20,000 in taxes, how long is it take me to recoup that?
Yeah.
How much tax-free growth? And she's 60 some years old. Okay. So not good math in her case.
Mm-hmm. Yep. But in some cases it makes sense. So be aware, run the numbers and see if that helps. So I think that what you just described is a word that comes to my mind, like misconception. Some people have misconceptions about many things. What are some misconceptions that people have about some of these tax-free retirement strategies? And then how do you address those?
Well, I think the one we just touched on is that one. Like you said,
That's
they
a good one.
Roth conversion, Roth conversion, Roth conversion. The lunchroom financial advisor,
Yep.
at the plant said, "Hey, my advisor told me to do a Roth conversion," and in that case, it may have been appropriate, but it's not, like you said. You got to know the numbers. It's not right for everybody, like I said, we look at all those opportunities and go, "Hey, there's an opportunity for you to do," and the tax free is a no brainer for me. If you're in that 0% tax bracket, which very few people are, but and I think 10 and 12% are pretty attractive rates.
Yeah,
I pay 10% today, 12% today. Maybe that's palatable for a Roth conversion. Mm-hmm. When you jump up from 12 to 22, that's another 10%. That's a pretty good jump.
Yeah,
and so it's not for everybody. So it's just kind of just having those conversations and dispelling the myths.
Yeah,
it's just not always roses.
And like you said, regarding tax brackets and 10% and 12 and 20 and all of those things, that's what we know today. Well, right. As we know, no matter who's in office and what government or Democrat or Republican, it doesn't matter, things can change. So taxes can change. Nobody knows what and how and when and how much. But talk a little bit about what you do to work with your clients to make sure that whatever changes come is going to be dealt with and maybe kind of putting some plans into place.
Yeah, great question. So exactly what we tell people is, hey, we're going to work with what we know exists today. I don't have a crystal ball that works. I don't know what the tax rates are going to be 5 years from now, 10 years now, whatever. But our process that we just talked about in one of our early episodes is making sure that we have two different buckets of money, one for income that's guaranteed, okay, over on the annuity side of the equation, if it's right for you. And then we have the growth side of the portfolio over there to add some flexibility. So there's enough flexibility built into the plan to, like you said, if there's a considerable change in taxes, it could be a considerable change in your standard of living. We want to make sure we've designed a plan to take the impact that might have on you down the road.
To have that buffer. And then if it didn't have that big of an impact, then you've got the buffer and that's great. But what if the taxes did, make the move that you predicted? Well, now you're ready and it didn't impact your lifestyle because you planned for it.
Yep. That's where the Roth conversion can be key because now we've taken advantage of the tax rates, converted some money over here. So now we have access to it tax-free, mm-hmm. Maybe to add in, that cover that gap where the increased tax may have.
Yeah, I know we've been talking about tax-free retirement solutions, and that tends to be like me, myself, and I. Your back pocket. I need to get to retirement. I need to get through retirement. But there are some people out there that have enough funds that they're like, look, I got enough money to get to and through retirement. Let's make sure we make the right tax moves, all of that. But then we're going to have a bucket of money left over that we're going to transfer to our heirs for like legacy planning. So talk a little bit about some of the tax considerations as it relates to legacy planning, because one of the gifts that you can give your family is knowing that funds get transferred to them where they don't have to take a big tax hit.
Yeah, very good. Very good. Yeah. So one of the solutions, I won't say it's the best one, but it's a very good solution for legacy planning and for those individuals that you just described is life insurance. Okay. So they can fund life insurance, which is what I'm doing for my family. Is funding a life insurance policy, which will pass income tax free, and under current estate tax exemptions, it will pass estate tax free to my two sons and my grandchildren. So life insurance is a great solution. It's another one of those things like we talk about when people hear annuities, go, they just have this negative reaction to it, and they never sit down and get educated on it. The same thing with life insurance. There's all kinds of different life insurance, and it can be a great tool for legacy planning and tax-free transfer of wealth to the next generation.
Because certain types of life insurance, and again, like you said, let's not get into the weeds, but certain types can have living benefits as well. So cash value growth, or, ooh, I need long-term care and I didn't get a long-term care policy, but there's some of these types of things that give you some benefits even before you pass. But then to your point, if it's the right kind of policy set up the right way, it can pass funds to your heirs and benefit them. So I think, like you've said before, oh, this word makes people think red flag. This word makes not all the time. Let's look at it. And on the other side of the spectrum, oh, this strategy is the best one for me. And because no, it needs to be looked at like what you've said over and over from a holistic approach. Let's see if this particular move benefits you. Let's take everything into consideration and make the right decisions.
Exactly. Yeah. Couldn't have said it better myself.
Well, with that thought in mind, then, if someone is interested in hearing, okay, tax-free, mitigate taxes, lower taxes, make some of these moves ahead of time, how would that impact me? What's the best way that they can learn a little bit more and reach out and connect with you and see what some of their options would be?
Yeah. So to learn all the things possible for you to avoid taxation or minimize taxation, call 833-DAN-HILL. It's a toll-free number, 833-DAN-HILL, or go to hillwealthstrategies.com. And either one of those, you'll get have the ability to sign up for a complimentary consultation. And we look forward to talking to you and helping you avoid or minimize your taxes.
Excellent, Dan. Well, as always, it's been a real pleasure chatting with you. Thank you so much for coming back on.
Always great to talk with you, my friend.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.